Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about JABIL INC Annual Report. JABIL Inc. offers a diverse range of services and solutions across various industries. The company's key businesses include electronics design, production, and product management, electronic circuit design, including application-specific integrated circuit design, and firmware development, 3D mechanical design and analysis, industrial design, mechanism development and tooling management, computer-assisted design services for PCBA design and validation consulting services, such as bill of materials generation and assembly equipment configuration, product and process validation, including regulatory compliance and reliability tests, manufacturing test solution development systems assembly, test, direct order fulfillment, and configure-to-order services. These services cater to various industries, including 5G, wireless and cloud, digital print and retail, industrial and semi-cap, networking and storage, automotive and transportation, connected devices, healthcare and packaging, and mobility. The significant increase in JABIL Inc. stock price, a year of robust financial performances and strategic investments. JABIL Inc.'s stock price has experienced a remarkable surge of 64.41% in the past year, driven by a series of strong financial performances, strategic investments, and a focus on high-growth sectors such as artificial intelligence, AI, infrastructure. The company's consistent reporting of stronger-than-expected earnings and revenues throughout fiscal year 2025 was a key factor in this increase. JABIL's strategic pivot towards AI-driven growth areas has been pivotal in driving its stock price up. The acquisition of Micros Technologies, a firm specializing in liquid cooling solutions for high-performance AI servers and data centers, bolstered the company's capabilities in thermal management. Additionally, JABIL's $500 million investment in U.S. manufacturing operations, targeting cloud infrastructure and AI sectors, demonstrates its commitment to expanding its presence in these areas. The company's partnerships with Aptronic for humanoid robots, Ciphered for AI-powered procurement, and Axiato for AI-driven cybersecurity further highlight its focus on leveraging AI to drive growth and innovation. These strategic investments have not only enhanced JABIL's capabilities, but also increased investor confidence in the company's ability to navigate the rapidly evolving technology landscape. Furthermore, JABIL's consistent financial outperformance has been a major contributor to its stock price increase. The company's strong quarterly earnings and raised outlooks throughout fiscal year 2025 have exceeded analyst estimates, leading to positive ratings from Wall Street analysts and increased investor confidence in the company's strategic direction. In conclusion, JABIL Inc.'s significant stock price increase over the past year can be attributed to its robust financial performances, strategic investments, and focus on high-growth sectors such as AI infrastructure. As the company continues to navigate the rapidly evolving technology landscape, its commitment to innovation and growth is likely to drive further increases in its stock price. The primary drivers of revenue growth or decline is influenced by several key factors. Customer concentration plays a significant role, with some customers accounting for a substantial portion of net revenue. For instance, customer A accounted for 16% of net revenue in FY 2025. The intelligent infrastructure segment is another major contributor to revenue growth. Geographic expansion also drives revenue growth as the company expands into new markets such as the Americas, Europe, and Asia. On the other hand, divestitures and acquisitions can impact revenue, with the divestiture of the mobility business contributing to a decline in revenue. Overall, understanding these drivers is crucial for making informed business decisions. The financial performance of JABIL Inc. experienced significant fluctuations between 2023 and 2025. Net income decreased by $731 million from 2024 to 2025, reversing a previous increase of $818 million from 2023 to 2024. This decline was attributed to various factors, including uncertainty in customer orders, production delays, inventory write-downs, component shortages, price increases, increased competition, transportation issues, and difficulty retaining skilled personnel. Profit margins also underwent changes during this period. The gross profit margin decreased slightly from 9.33% in 2024 to 8.92% in 2025. However, the operating income margin showed a more significant improvement, increasing from 0.01% in 2024 to 3.97% in 2025. The net income as a percentage of comprehensive income remained relatively stable at 96% in 2025, compared to 101% in 2024. Overall, the decline in net income and profit margins can be attributed to a combination of internal and external factors that affected JABIL Inc.'s operations and financial performance. The company is generating a significant amount of positive operating cash flow. According to the financial summary, the net cash provided by operating activities for fiscal year ended August 31, 2025 was $1,640 million. This indicates that the company's operations are producing more than enough cash to cover its expenses and investments, resulting in a substantial surplus. The company's debt level and interest expenses have undergone significant changes over the past few years. Initially, the debt level increased from $500 million in May 2026 to $600 million in January 2031. However, by 2025, the total notes payable and long-term debt had only increased slightly from $2,880 million to $2,885 million. In terms of interest expenses, there has been a notable decrease. In 2024, the interest expense was $173 million, which decreased to $147 million in 2025, representing a 5.7% change. This trend continued with an even greater decrease in 2023, where the interest expense was $206 million. The company's ability to manage its debt and reduce interest expenses is a positive sign, indicating effective financial management strategies. However, the minor fluctuations in forward foreign exchange contracts suggest that there may be some volatility in the company's financial performance. The company's financial performance varied across different segments and regions. In terms of regions, the Americas, Europe, and Asia all performed well, contributing positively to the company's overall growth. However, China operations struggled due to several challenges, including tariffs, regulatory risks, and labor turnover, which negatively impacted its performance. For management's outlook and strategy, the company's management is optimistic about the future, citing factors such as efficient manufacturing and customer demand for integrated services. They plan to build strong relationships with customers, diversify products and industries, and leverage global production to reduce costs and improve quality. To achieve this, management will pursue strategic acquisitions, invest in R&D, and focus on advanced technologies. They also aim to develop long-term relationships with leading companies in high-growth industries and provide leading-edge technologies and solutions to customers. However, management acknowledges the challenges of forecasting demand and managing working capital requirements due to changes in customer behavior and industry trends. They are also vulnerable to international trade disputes and tariffs, which could impact their business and financial condition. To mitigate these risks, management plans to pass on tariff costs to customers, utilize advanced technologies, and expand global production facilities. They also anticipate adequate liquidity sources to fund capital expenditures, dividends, share repurchases, acquisitions, working capital requirements, and contractual obligations for the next 12 months and beyond. Overall, management's strategy focuses on building strong relationships with customers, diversifying products and industries, and leveraging global production to reduce costs and improve quality. They are committed to investing in R&D and advanced technologies to drive growth and competitiveness. The company has made several strategic moves through acquisitions and divestitures. Key acquisitions include Pharmaceutics International, Inc., PA, and Micros Technologies LLC, Micros Technologies, manufacturing and supply chain management operations from customers outside of the U.S. ASR transaction completed in July 2025. On the other hand, the company has also divested certain assets, including acquired facilities sold at a loss, certain manufacturing facilities or operations transferred to other geographies' businesses, resulting in a $2 million gain from foreign currency translation. The company's financial summary reveals that it has a history of paying dividends to its shareholders. Specifically, between fiscal years 2016 and 2025, the company made total dividend payments of $504 million. This indicates a commitment to returning value to investors through regular distributions. Concerns about inventory buildup and supply chain disruption. The company faces significant risks related to inventory buildup and supply chain disruptions. Excess and obsolete inventory adjustments are included in the cost of revenue, which may negatively impact margins. Rising component and material prices also pose a threat to profitability. Furthermore, tariffs on imports from certain countries, including China, may affect end customer demand. Supply chain disruptions are another major concern, with potential causes including delays from common carriers or transportation issues, shipping problems due to carrier issues, and increased costs resulting from these issues. Natural disasters, pandemics, labor problems, energy price increases, and criminal activity can also disrupt supply chains. Additionally, tariffs and protectionist measures may limit manufacturing capacity, leading to inventory buildup. The company's operations in new markets may be particularly vulnerable to startup expenses and low margins. Labor turnover rates are high in China, which could further disrupt supply chains. Energy price increases or shortages may cause disruptions in operations and increase raw material costs. Overall, the company must carefully manage its inventory levels and supply chain to mitigate these risks. That concludes the financial summary for JABIL INC. Feel free to comment below, and I will be happy to answer them when possible.